What I'm about to share with you in this video is potentially going to be the best trading lesson that you could possibly learn. Not only is it going to get you excited about the markets, but it's also going to make you look at markets in a different way that will immediately give you an edge over most of the traders that start or try their hand at trading, which puts you at the forefront, which puts you in the minority, which gives you a competitive edge to make more money in the markets. So first of all, I'm going to walk you through some rules that you want to pay attention to when you look at any market, and that alone will get you excited. Then what I'm going to do is I'm going to walk you through a real setup that's playing out right now, and I'm going to get you to apply all of that knowledge to this particular setup. And then what I'm going to do is I'm going to show you exactly how to apply what you've learned in a real market so that you instantly see the benefits in your own trading. So grab a pen and paper on this one. You're going to want to take notes. You're going to want to probably save this video for future reference, because this is going to be something you're going to use in all of your trading from here on out. And let's get stuck in. Go and download the Wall Street cheat sheet. And the Wall Street cheat sheet was a study of predictable patterns that are very common on IPOs or ICOs, coins as well, right? When Bitcoin came about, the first time that I invested in Bitcoin was many years later, after the Wall Street cheat sheet. You can almost overlay that identically over Bitcoin. In fact, you put them side by side, they're pretty identical. Now, this is just one observation, one pattern, one long-term observation of psychology behind the markets. And that should get you excited, because if things are that predictable, it means that within every single move, there are more predictable patterns that we can build what I call board game set of instructions around to execute consistently to profit on these moves. And that's what a trading strategy is. To start looking at building one of these strategies, we need to understand all of this stuff. We need to go and look in the markets, and we need to find some of this stuff going on. And before I go out, I'm going to do some drawings. I'm going to show you in the market. We're going to look at live markets in a second. I want you to understand how markets move, first of all. The markets move up, down, sideways, right? If they're moving up, this is what we call an uptrend. And typically what you see is higher highs and higher lows. Okay, so bottom left to top right. In a real world market, it doesn't quite look as pretty as black straight lines on a white background, but it does. You know, you should be able to identify higher highs and higher lows in real time. And we'll take a look at a real market in a moment. Same with a bearish trend is the opposite. This is where we're going down, the market's going from top left to bottom right, and we're putting in lower lows and lower highs, and that's what we refer to as a downtrend or a bearish trend. And if you're in a trend, and if you're in a trade and you're going down, you are short. Okay, so short is down, long is up, and those are other terminologies for trading executions if you're in a trade going up or in a trade going down. In real time, this is what it looks like. Bearish trend is a downtrend, lower lows, lower highs. And then there's sideways movement. This is like a ranging market. You see this very common on the euro dollar. Has some great structure consolidation like this, where you can capture some nice 4 or 5 moves within this by selling the highs and buying the lows. And if you're in my live room, you would have seen me do this many times. And in the real world, it looks like this. So you're looking for entry signals at highs and lows, and you can make a killing in a couple of weeks just off of trading this in some of the markets. Aussie dollar's good at it, euro dollar. Okay, and then finally, there's choppy, indecisive markets. Okay, and this is where it's more erratic. There's no clear highs and lows, and it's constantly violating structure. And, you know, typically you want to steer clear of those type of markets. Usually, for me personally, there's never any setups that are worth their weight in that particular situation. So I usually veer off and stay away from those markets whilst it's in that situation. Now, you do have to refine your eye, and you have to learn how to differentiate between these and identify each of these, because if you think it's a certain situation and it's another situation, then your trades that you're looking for in that situation will be lower probability. So let me give you an example. If you're bullish, but the market's just going into consolidation and you're still looking for bullish setups because you're unable to identify the consolidation properly, then you're going to start taking low probability setups and giving money back to the market. The next thing is when we're putting in new highs, higher highs and lower lows, the terminology for those are runs and pullbacks, or extensions and retracements. Okay, some people call them outside returns, retracements, but they are basically runs and pullbacks. Okay, and you can see here in this chart, I've drawn this kind of nice little diagram here that indicates the green being the run phase. So phase 1 is a run, phase 2 is a pullback, then you have a run, then a pullback, run, pullback, and so on, right? And there's a bit of indecision or sideways movement here, consolidation. And then we have a run, putting in a higher high, pullback, run, higher high, pullback, run, higher high, and so on, okay? What we're looking to do as traders is we're looking to buy after pullbacks in a bullish trend and sell after the runs. Now, you're never going to catch the perfect bottom and sell at the perfect top, but you're going to understand how to take the majority profit off of the table and not be greedy. The next key thing to understand is support and resistance. So far, we know markets move up, down, sideways, indecision. We know that they move in higher highs and higher lows, or lower lows and lower highs. We know that there are runs and pullbacks, okay, extensions and retracements. And we also know that we're looking to buy the low and sell the high in a bullish trend, or sell the high and buy the low in a bearish trend. The next thing that we need in our little toolbox that we're building up here is support and resistance. So markets support is where market pushes down and a particular price level is respected time and time again. And just think of it like you throw a tennis ball at the floor and it bounces, okay? And when you can identify this, particularly on higher time frames, say the monthly time frame or the weekly time frame, and you have multiple tests of these levels, that can be a really, really powerful indication that the market will test that level again, and guess what? Respect it. So a bit like the Wall Street cheat sheet, very, very predictable. Same for what we call resistance. So if you think of throwing a tennis ball at the floor, that's support. If you throw a tennis ball at the ceiling, that's called resistance. If it bounces off of the ceiling, that is resistance. So we have support, low level, resistance, high level, and it's the same thing. It's a level in the market, a price point that is respected time and time again. And if we're looking on the higher time frame and it's respected 2, 3, 4 times, that holds a lot of weight for a potential setup for us to short this market if we ever test that level again. Another great thing that you can use to your discretion, which immediately will enhance your edge as a trader, is look at even handle numbers or 50 pips, 0.5. When you go to fill up your car at the petrol station, who tries to stop it at bang on £80, £100? You go, and you don't want to go over like 2p over or 2 cents over, right? 3 cents over. Try and get it bang on the zero. Why do we do that? Well, who cares? We just do it. And guess what? All of the other humans do that. So what did I say? Humans drive the markets. Humans respect even handle numbers. Who knows why? I don't know why. I don't care. I just know that they're predictable. So I encourage you to go and look at the markets and just go out to the daily time frame, go out to the 4-hour time frame, whatever you might choose, and just put horizontal lines at every even handle number and every 50 level. And look, I've done that for you. I've got this little screenshot here where every dotted line, every dark dotted line is an even handle number. So you can see I've got 7,900, I've got 8,300, 8,800, 8,900, 9,500. And then every light dotted line is a 50 level. So this is 85.50, this is 92.50, this is 80.50, this is 81.50. And look how the market behaves, guys. Support, resistance, support, resistance, support, resistance, support, resistance, resistance, support, resistance, right? Phenomenal. Love it. And no matter how long I see this stuff or how many years I've been looking at this stuff, I never tire of it. And what you often find as well is previous resistance becomes support. So when we're in a bullish trend, if we're in a nice harmonic trend and we're in, a nice flowing trend, you see that the higher highs or the higher lows become the previous higher highs. So they respect the previous higher highs. And the higher low respects the previous higher high. What you also get are things like trend lines, so angular support. So support doesn't have to be horizontal, it can also be angular. And you can see here, if you're familiar with trend lines, we can use these tools to our advantage. Imagine stacking all of this together, by the way, guys. Everything I've showed you just in these last, 10 slides. Imagine you combine all of that knowledge and now you start looking for trade setups. And you've got the discipline and patience to only look for the best setups when all the stars align. When you can tick every one of these boxes. Instead of just trying your hand at this strategy, that strategy. Imagine you've got the discipline and the patience to wait for all of this to line up. And how much higher probability do you think those setups will be? Get where we're going with this. Same with downtrends. So you get downward trend lines and you get resistance, angular resistance. And you also get structure swaps. So what was angular resistance can become angular support. Now, a lot of you won't see things like this when you're new and you're looking at the markets, but when you refine your reticular activating system, which is a part of your brain that stops you going mad, helps you see patterns, right? And you look at the charts and you understand what you're looking at, these things start to become second nature. So how I look at the charts is completely different to how a rookie or uninitiated trader would look at the charts, because I can see things immediately that they can't see, and that is my edge. That's an edge. Other things we can stack into our confluence, our case for entry, are things like indicators, so exponential moving averages. Exponential moving averages, if you're using a combination of exponential moving averages, it can be very, very powerful, because although it's a lagging indicator, it will, if they're all fanning out in the right order, we can pretty much safely say that the market's going to carry on in a certain direction. And when they start to cross, we can see potentially this is the start of the end of a trend. And you can use these to great effect. You can use an oscillator like the MACD or the RSI, and if price action is putting in higher lows and the oscillator's putting in higher highs and higher lows, that's what we call convergence, which means the trend is likely to carry on in that direction. Divergence is the opposite. So when price action is putting in higher highs and higher lows, but the oscillator's putting in lower lows, then the chances are, like this here, see this? We've got this green line here putting in higher highs, and then the oscillator's putting in lower highs. That's called divergence. And what that usually means is the trend is coming to an end, or the market's running out of steam. When you combine all of that stuff, you can start to see how it's not random. There are patterns to this stuff. And although we never know what the market's going to do definitely next, we can plan and have strategies to attack every situation. Wow, this is a nice setup, okay? So let's take a look at this. I'm going to just share this. So I just had an alert here. Where we're trading right now, I had an alert. Can everyone see this little red rectangle down here? There's 4 pieces of information that you need to understand about candlesticks, okay? I don't want to teach you to suck eggs too much, but for some of you, this is brand new information. And I just need to just quickly go through a few things. On a green candle, which is what I've got colored, it means that the close was higher than the open. If it closes lower than it opens, it's colored red. It's called a bearish candle. And if it closes higher than it opened, it's green, and it's called a bullish candle. So the open is here, and then we have the high, the low, and then the close up here. We close. And that's the activity of what happened during that hour. In the red candle, we open here, we have the high, we have the low, and then we have the close here because we closed lower than we opened. That's why it's red. Now, why am I interested in this market? Well, let's take a look. Based on everything we've just learned, okay, I'm going to take a horizontal line. This is a live market, by the way, guys, so I can't manipulate this. I can't show you all the nice things where it's all working out perfectly. But I had an alert down here, and the reason I had an alert down here is because let's check out what's happened previously on this particular market, right? So look at this. We had, take notes, a rejection. What is this called? What is it called when we have rejection like this? Resistance. Yes. Once we broke above it, we had support. Support again. Then we broke through. Then we had resistance. We had this head and shoulders type deal going on here. Resistance. Let's get, I think we should just get this, right? And then we had resistance, resistance, resistance. We had support in here. Then we have resistance, right? And then look at this. Who thinks this is a good level of structure, by the way? Look at that. What a beauty. What a beauty. So now we haven't tested this level since June 24. This is the daily chart as well, yeah. So the daily chart's going to obviously hold a lot of water because it's a powerful chart, right? It's a powerful chart. Since June 24, we haven't tested this level. And this level just so happens to have been tested and respected about 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, multiple times. I haven't even gone back this far. Look, 1, 2 here as well. You can go on and on and on. So would everyone agree, just from what you've learned, would you agree that that is considered a powerful level of structure for a reversal? Okay, for the weakening in a trend, for a little structure-based long. I've been bearish this pair for a long time. But now we're at this level, do you think it might be stupid to short this? Do you think it might be a bit silly now to start looking for shorts? This is what people do when they don't know what they're doing. They're going, oh, this is dropping off a cliff. Just sell it. You know, this is bearish. This has got a strong sell signal. Sell, sell, sell. Well, look, what do you think will happen next? Now you know this. You're already a better trader from already. You're now not going to sell that anymore, right? No more shorting. So look, what else can we see here? What else can we see here? Based on it, everything, I want you guys to rack your brains and I want you to think about everything I've just taught you. I want you to come up with something else that we might be able to pay attention to here. Something else that we might be able to pay attention to that will allow us to add weight to this order that will be a real high probability setup. Psychological numbers, right? So let's kind of add up our little scoring system here, right? 1, major support. 2, psychological number. What we've got here is the 50 level. Look at that, 89.50, right there waiting for us, 89.50. What did I say about the oscillator and having divergence? Reverse, right, so look at this. Lower, higher. That, my friends, is what we call divergence. I'm using it in conjunction with setups like this so that it adds major powerful confluence to my setup because I've got the patience and the discipline to look for the best setups only and wait, and if my rules aren't met then I'm not getting in. What else? Market's running out of steam. We've got a little bit of price action running out of steam here. We've got what we call a descending channel, which is a talk for another day. That's a price action pattern. So what we can do now is, this is the daily time frame. If this is your trading time frame, what you could do is literally wait for a candlestick pattern to play out here, right? So we've got the price action pattern. You wait on the daily and you just come back to this tomorrow and you look for something called a low test candle, which would look like this, right? Now, what do you think? What sort of story does this tell us about this candle if it plays out here? What that means is we've opened, the bears have tried to push down lower, bears have tried to push down lower, and then the bulls have rejected and we've closed right back where we started. Now, what would you think is going to happen next following that signal? Likely to push up, right? one way to enter would be to wait for the close of that candle, and you'd have to wait for the close, because if you don't wait for the close, guess what? It might not be that setup of candle. So you wait for it to close, and then you can place an order, a buy stop order, above the high of that candle, and then a buy stop order so that you're triggered in and your stop loss can go below the low, and then you can select your target zone or put a target in the exponential moving average zone or structure based targets or whatever. But that's one way. The other way, if you're a bit more conservative, is you say, well, it's all good having this candle, but what I need is another candle to close above that as well. So you want added confirmation, and that's what we call a 3-bar reversal. Okay, so a 3-bar reversal is where you have a 3 candle setup, this candle here, and then you wait for the rejection candle or the doji candle, the indecision candle, and then you have a higher close candle than this candle, and that is your entry. You enter at market at that point, as long as we close above. And that's called a 3-bar reversal. Now, the reason you might have different entry techniques is based on the score. So in this case, we've got major support, structure level, we've got a psychological number, we've got RSI divergence, we've got, a price action pattern. So you've got, say, 4 or 5 points for this trade. Now, if you have 4 or 5 points, you might have to wait for a 3-bar reversal. If you have 6 or 7 points, you might have to, you might just wait for this candle. If you have 8 or 9 points or 10 points, you might just literally enter at market when we hit this level. You might set a limit order. As you're becoming more dynamically aggressive or conservative, depending on the quality of the setup, you could change how tight your stop loss is, how aggressive your target is, how aggressive your position size is, how much breathing room you give your stop loss, how you enter the trade. And depending on having a scoring system and you link that with how you manage the trade, that is how you're going to become the best trader in the world. People get so stuck in one strategy, I've got to trade it this way, and they don't develop, they don't dynamically adapt to situations to maximize profit. And as their edge starts to deteriorate over time, they're not keeping up. They're not becoming proficient. They're not becoming better, which is why they end up losing money over time. So you want to be able to think, I want you guys to think of your trading like this from now on. I want you to think of dynamically approaching the market, but don't confuse that with random. It has to be consistent. You have to have a plan and a scoring system for setups, and depending on the scoring system will allow you to get in a certain way, to be aggressive or conservative, to wait for certain things to play out or get in early, and then it will determine how you set your position size, how much risk is on the table, how tight your stop loss is, how far away your target is, or how aggressive you are with targets, whether or not you take 1 position or 2 positions, whether you trail stops or just have a set target. All of these things should be dynamic based on your ability to identify high probability setups. All right, pretty cool, right? We've fast forwarded now to Sunday evening. Currently it's Sunday evening and the market's open in about 5 hours from now, just under 5 hours. And I want to show you what happened, because that recording that I gave you just now where I was looking at the markets live was a couple of days ago. That was Thursday. It's now Sunday. So we had the Friday, then we closed. Now it's Sunday and the markets are about to open. And I want to show you what happened. So look at what happened here. This was our drawing. This is exactly how we left it the other day. And what's happened now is the Friday close candle is almost identical to what we drew out. It's not a doji, but it's a low test candle wick, and the upper and the open and the close is in the upper third of the entire candle body, which in itself is considered a rejection candle, which is great, right? We know that it's all closed above these previous lows as well, so we haven't got to worry about it being a new low or anything like that. So this is a great, we predicted all of this stuff, and now it's playing out in real time, and this isn't hindsight, right? I'm putting this out. This is Sunday night. I don't know where this market's going to go, but I have a high degree of certainty in my predictions for the probability of what's likely to happen next, which gives me an edge as a trader. Okay, and it's having the patience and the discipline to wait for these without getting itchy fingers or feel the need to get involved or have FOMO. I want all of the rules on my terms. Okay, so now look, how can we get involved? Well, depending how aggressive you are, you know, you could either just enter, as I say, you have a buy stop order right above the high. Okay, and the reason we're going right above the high, let's just delete all this off now. You set a buy stop order right above the high and you just go to bed, right? And the idea of that is the buy stop order is telling your broker, I want to get in, I want to get long if market pushes above the high of this candle, this rejection candle, this signal candle. Okay, so it gives you added confirmation that way. So it's still not like ultra aggressive. And then you place your stop loss below the low, and then you'd just be in. You'd be triggered in, and your target would go at the 50 EMA or wherever you choose to put your targets. Okay, maybe previous structure, maybe you trail stops. But if you're a bit more conservative than that, you either wait for the 3-bar reversal, which means you're going to have to wait till the close of Monday's candle. So on Monday night, on the close on Monday. Or other things that you can do is you might be looking at things like angular resistance for a reversal. So as soon as we break and close through the angular trend line, the reversal zone, then you start to look for entries, right? And maybe you wait for a close above that, then you place a buy stop order, or then you place an at market order, or then you just get in as soon as we close above this line. Okay, so I hope that's been valuable. I want to leave it there because I want you to look at this market. I want you to go and look at the pound Aussie, and I want you to observe what happened next. And guess what? It's not always going to be right. But I want to get into your head the power of probabilities, because that, my friends, is all trading is. It is building high probability, predictable patterns and setups around predictable patterns that have proven to respected certain things historically, and we mimic that in real live markets, and then all we need is the discipline and the emotional regulation to be able to execute on that very, very consistently with military grade precision. So I hope you enjoyed this video. Now, this training was part of a recent webinar that I hosted, which was almost 3 hours long. If you would like access to that whole recording, okay, type in the comments webinar, and I'll consider releasing that to you guys if we get enough demand. But until next time, apply this to your trading. It's going to instantly make you a better trader. And if you want to learn more like this, you can always go over to tier1trading.com or join my 30-day trader challenge. I'll put the links in the description. Until next time, take care, good luck in the markets, and I'll see you then.